Okay, let's start. Uh, Today is the second day of our P2P revision sessions of F7. Now, our today's topic is ratio analysis or interpretation of financial statement. Ratio analysis or interpretation of financial statement. First, first of all, first of all, I'll be giving you a generalized lecture, what mistakes students do, and this generalized lectures is connected with different examples of past papers, right? Okay, so listen it very attentively and very carefully, okay? Right? Now, first of all, ratio analysis is, for me, I think it's a compulsory part. If you take feedback from students, some students says in last 40 marks ratios with final account, one ratio question and one final account, and some students got one ratios and one consolidation question. So normally ratio is a must thing. Okay, even this ratio analysis is must for all qualifications. You go to CA, you go to ICAEW. If you see ICAEW final corporate reporting paper, SBM paper, in each and every qualification, ratio analysis is the essential part. Even for BBA students, MBA students, other qualification universities, this is the main part. Okay, for commerce students. So learn it very effectively. Now, first of all, what I have written, not only general commentary. Students normally they learn commentary. I will discuss many things which students learn, but try to connect things with the scenario. Try to connect things with the scenario given in the question. Yes, you can memorize few things. You can the generalized lecture of ratio is important, no doubt, no doubt it is important. But when you do a practical question, when you do practical question, you need to connect things with the question given in the scenario, right? Okay. Now, but try to connect with the business discussed in the question. I will be sharing few examples with you. Now, the first is, there was a question of past paper, old past paper question named Big Word. You might have done this question or not, but there was a question of Big Word. And the first part of the question was related to practical cash flow, and the second part was commentary discussion. Okay. Now, in that question, the company had two business segments. The first was clothing business, right? Like a boutique or something. And the second was food business, like a restaurant or something, right? Okay. Now, normally what happens, what is the real business sense? What is the real life business sense? Food normally sells in quantity. We eat three times. Each and every person normally eats three times. But do we buy shirts daily, or we buy after 2 or 3 months we buy shirt? So that means the sales, think from the seller point of view, the sales of shirts and dress pants and jeans is lower than compared to food sales is very fast, right? So normally in real life, how food companies operates, they sell things in quantity. They do sales in quantity with lower margin. Why the lower margin is still enough? Because they sell in quantity. They sell million units or 1 lakh units or so with that huge quantity, of sales, per unit profit lower per unit profit is still enough for them. Not getting. But normally in clothing business, if you are doing a clothing or textile business, you need a good margin because the quantity compared to food is lower. But in this question, what happened? Listen, their clothing business had lower margin, lower GP margin. In the question, it was written that the clothing business has lower GP margin and food business has higher GP margin. Not getting. Clothing business has lower margin and food business has higher margin. So you need to write something in the commentary that why. Maybe possible. Now listen, may be possible that company has some specialized nature of food. You have seen some specialized restaurants even in your city, that they don't have any other competitor. Like for example, in Karachi, Nando's peri peri chicken is very, Nando's peri peri chicken is, the taste is very different. Worldwide, I know there in one city there are many competitors of peri peri, but in few, In some cities there are only one peri peri restaurant or two, so that means you have a special taste. So if somebody has a special taste, then people will pay more for it. Okay, so you need to connect like this the real life business sense. Then see, generally in food business, sales of quantity and lower margin means one more thing, you know, with the food business, look at me very carefully. With the food business, food is a perishable item. So for food business, normally inventory days should be lower. Inventory days or inventory holding period should be lower because food is a perishable good. Are you getting? So in this question, in the big word question, it was written that they increase the prices. They increase the prices of food. They increase the prices of food. They increase the prices of food. Why they increase the prices of food? In order to get higher margins. In order to get higher margins. So normally, according to law of demand, when you increase the price, customer goes away, then your speed of sales decrease. But when we looked when we looked on the inventory days, in the same question, the inventory days went down. So that means despite of increasing in sale price, still their sales is very fast. That means they have a quality product or they have less competition. So you need to connect these things in the answer like this. Okay, now one more thing. Similarly, sometimes costs are apportioned between segments. Look at here. For example, again, I have two businesses. I have clothing business plus food business, clothing business and food business. And my clothing business boutiques are so many boutiques. I have let us say I have 15 boutiques of clothing, and I have only two food shops, 15 clothing boutiques and only two food shops. So floor area, floor area given in the question is, see this, floor area floor area given in the question is 45,000 square feet for 45,000 square feet for clothing and 5,000 for food. 45,000 clothing and 5,000 for food. Total floor area is 50,000. Total floor area is 50,000. Now let's take out the percentage. Let's take out the percentage according to floor area. So 45,000 divided by 50,000 into 100. 45,000 divided by 50,000 into 100 is 90%. And 5,000 divided by 50,000 into 100 is 10%. So clothing has 90% floor area and food has 10% floor area. Now in that question, it was written that look at me, that accountant apportioned all cost, all depreciation. Accountant apportioned all depreciation using the base of floor area. Accountant 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 apportioned all depreciation using the base of floor area. So now you just think 90% of the cost must have been gone to clothing and 10% he apportioned to food, because food has less area. Now you just think, sometime you have to challenge the base, that the base is wrong, the base should be different. Like if you have studied F5 paper, ABC costing, just think, just close your eyes and imagine a boutique. Just close your eyes and imagine a boutique. And then imagine a food shop. In boutique, you will find shelves. In boutique, you will find shelves and furniture. But in food shop, you will find machineries, different machineries, cooking machineries and something like that. Now you decide yourself. Do we depreciate, do should we depreciate clothing equipment faster or machineries? Machineries lose the value faster because machinery are connected to electronic items or so machineries loses the value with higher speed. Not getting? So the real base should be, what should be the real base? We should give more share of depreciation. We should give more share of depreciation to food sector and less share to clothing. But what base we decided? We decided the base of floor area, which is a wrong base. So sometimes you need to challenge, you need to challenge the basis on which they are apportioning the cost. That's why the results are different. That's why clothing business are not looking good and food business looking very good. Okay, so that's the possibility. Read this line. I'm giving you 1 minute. Read this line, please. Are you guys with me? Please comment. You getting? You getting the point? Ratio analysis is a little bit business related topic. So I need to go some to high level as well. Okay. That's the need of your paper. That's why. Now, these are few things which are very common in many questions. That's why I've written here many questions. If you see, like in 10 questions straight away, GP margin, operating margin, that's very common thing. That's a wholesale thing, I say. Listen, and you must know these few points. You know, what's the reason for increase in GP margin? Normally when selling price goes up, margin, GP margin goes up, selling price goes down, GP margin goes down. The first factor. And the second factor is cost. When cost of sales or cost goes down, margin goes up. Okay, so don't forget these two. Normally you need to comment on GP margin using these two tools. But yes, you have to use these two tools, but then you need to prove according to the question as well that sell that GP margin increased. Why? Because selling prices increase. And why selling price increases? Because maybe there are less competition. Maybe we are alone in the market. Maybe we are connected to a brand, and normally branded goods are expensive. So you need to prove, you need to use these tools and then connect with the question as well. Not getting. Just these points are not enough, plus connection is also needed according to the question. Okay, now reasons for operating margin is PBIT upon sales into 100. The first and very famous commentary, carried forward effect of GP margin. Listen, it's very common. Just think, this is GP, let us say 1000. Operating expenses is 300. So automatically your PBIT is 700. Just think, if your GP will go up, automatically your PBIT will also go up. So whatever happens with GP happens with the same thing happens with PBIT as well. So this is a very routine commentary that the first point to start with in the question, if GP margin is going up and also operating margin is going up, so you need to connect that operating margin following the GP margin, right? Then few things you need to see. One of this is double F, sorry, one of expenses. Sometimes the difference between GP margin, the difference between GP and PBIT is operating expenses. Look at here, dear students, the difference between GP and PBIT is operating expenses. So sometime operating expenses are artificially overstated just for 1 year because of one of things. Maybe this year we did something illegal. We broke the law and we got a big penalty. So this is only for 1 year. Or just think, the coronavirus, the COVID-19 thing. The COVID-19 thing is a one-off thing. Like it came this year. Maybe inshallah next year there won't be such things, so everything will be normal. So this year we can say that this is a one-off thing. Okay, so always point out the one-off thing. Then one-off gain on disposal. Yes, this is the very famous commentary, very famous point, normally comes in exam. And do listen one thing very carefully. In your F7 paper, this is your good luck. I should say this is your good luck, that examiner repeat things after years. if you see final account adjustment, consolidation adjustment, you will find similar adjustment. Many times they give similar adjustment. So that's an opportunity that you can clear. So this is also one of gain on disposal. See, there is a possibility that company has 4 divisions. Listen, look at me. Company has 4 division and company sold one of them. Company has 4 division and this year company sold one of them. So because of that sale of division, there is a gain on disposal in your question. So this gain on disposal is a one-off item. After many years it came. It won't repeat next year. It won't reoccur next year. So definitely you need to write that this operating margin is not real, because this operating margin contains a one-off thing. Getting? So these things give you mark. Higher operating cost, yes. Operating margins are lower because your operating costs are not in control, that you can connect. Now, something related to return on capital employed, something related to return on capital employed, very famous ratio. And I have seen some questions with almost 60-70% discussion on this. Rocky, return on capital employed, ROCE or Rocky. Okay, now what's the formula of Rocky? The formula of Rocky is PBIT upon capital employed times 100. PBIT divided by capital employed times 100. Look at here. What is capital employed? The first formula of capital employed is total asset less current liability, and one more formula of capital employed is equity plus debt. Equity plus debt. Okay, both formulas are equally acceptable. The first formula is total assets less current liability, and the second formula is equity plus debt. Okay, now listen. You might have studied this relationship. Rocky is the product of asset turnover and operating margin. Rocky, return on capital employed, is the product of asset turnover and operating margin. If you remember the formulas, say I can prove it. Asset turnover is sales divided by capital employed. I have written CE. Sales divided by capital employed, and operating margin is PBIT upon sales time 100. Okay, you remember this? So if you cancel this sales and sales, obviously you will get PBIT upon capital employed into 100. So this formula is valid. The return on capital employed is the product of asset turnover and operating margin. So normally in many past papers, when you are required to discuss return on capital employed, do write this formula and comment it. And normally one of these things are going down. For example, sometimes you can clearly identify that your operating margins are going down. Your operating margins are going down. So you can, after commenting on operating margins, you can connect on ROCE as well. That one of the reason of decline in ROCE is the decline is because of the decline of operating margin. Okay, so these are obvious cash marks which you can identify. Now see this I just told you. Now one more aspect of Rocky. Listen, Rocky is PBIT upon capital employed. Rocky is PBIT upon capital employed, and capital employed is total assets less current liabilities. Total assets, my dear student, less current liabilities. Listen, so just think, if the value of total assets goes up, just think, if the total assets are overstated, so your capital employed will also be overstated. If total assets, look at me and think, please be very careful. If total assets are overstated, that means capital employed are also overstated. And when your capital employed is overstated, capital employed is in the denominator. Capital employed is in the denominator, so your ROCE may go down. Your return on capital employed may go down. Okay, so this is one of the reason. Whenever you need to discuss return on capital employed in detail, don't forget to look at the carrying values of your assets. Not getting. My dear student, the formula of capital employed is total assets less current liabilities. That means capital employed has got connection with total assets and total assets valuation. So if total assets are artificially overstated or understated, this may affect ROS, and you need to discuss it. You need to discuss it. Now wait. Now I'm going more forward with this point. Also when comparing two companies, also when comparing to using revaluation and cost model, yes, you know this, one company is using revaluation model and one is cost model. You guys are no more kids, please, you are doing revision now. One company is using revaluation model and one is cost model, and market prices are higher. So the company using revaluation model, their assets value will be higher, so automatically their capital employed will also be higher, so they will have less ROS. And that's not the mistake of manager. That's not the mistake of manager. That's the issue of accounting policy. That's the issue of accounting policy, right? Okay, so normally you need to discuss this issue. Normally you need to discuss this issue of revaluation and cost model. Now the question is, sir, how can we recognize the revaluation model thing? How can we recognize the revaluation model thing? By using your eyes, by using your eyes. Revaluation reserve, in one of the balance sheet, you can see if there are two companies and in one company's balance sheet there is a revaluation reserve. In one company's balance sheet there is a revaluation reserve, so you can easily identify that this company is using revaluation model. Yes or no? Now now also, yes, this thing came in past paper, I saw it. Also, one company owns the property and the other company rents the property. Listen. Let us say there are two companies. The first is company A and the second is company B. Company A buys the property on ownership. Company A owns the property. So that means in the company A's books, the assets value will be higher because company A has bought the asset and recognized the asset in their own books. So their asset base will be higher. Their asset base will be higher. So accordingly, their capital employed will also be higher. Yes or no? But the other company B does not buy assets. They just take assets. They just take factories, properties on rent, like operating lease. So in this way, they don't recognize the asset. So one company is recognizing the asset, the other company is not recognizing the asset. So the company who is buying the asset, the company who is owning the asset on ownership, their assets base will be higher. And when assets base will be higher, the capital employed will be higher. So the ROS will be lower. Getting? So you need to comment and you need to score marks on this. Now, wow, very good, very good. Listen, F7 is a complete package. If you are in the ratio question, still you need to learn, still you must have knowledge of IAS, IFRS. Don't assume that you in ratio question you can't expect any IAS. Yes, they can give you IAS, they can give you consolidation. Yes, in the recent last 3 years questions, consolidation ratio questions are interlinked. In some questions, open your eyes. In some questions, grant, IS 20, government grant. Hope you remember. Listen, also in some questions, government grant is deducted from carrying value, of asset. I hope, I hope, I hope you all have studied IS 20 government grant. And there are two types of grant related to asset and grant related to income. We are right now discussing, we are right now, please look at me, please concentrate here. we are right now discussing grant related to asset. For example, I bought a property for $100,000, right? And immediately I received a grant of 20,000. I bought a property for 100,000 and I receive a grant of 20,000. Okay, so now I have two options of accounting. The first option, I book separate asset of 100,000 and I book 20,000 as a deferred income, separate deferred income of 20,000. And what's the second option? The second option is I can simply deduct the grant received from my asset. This approach is also allowed. Hope you remember IS 20. So if you are using the second approach, that means 100,000 cost of the asset less 20,000 grant. So your asset value will immediately go down. If you are using the second approach. And what happens when your asset value go down? Open your eyes, please. I need your energy. What happens when your asset value goes down? Look at here. When your asset value goes down, your capital employed goes down, and your rocky goes up. So in few questions, these are also the reasons. In few questions I have seen with these eyes that examiner comment on such connections. Examiner makes such connection, and these are scoring marks. These are not ordinary commentary. Okay, so whenever you need to discuss, whenever you want to discuss rocky return on capital employed in detail, don't forget to discuss the carrying value of non-current asset issues. Don't forget to discuss the carrying value of non-current asset issue. I have a question from all of you, if you are active. Cost model in IS 16, there are two models: cost model or and revaluation model, right? Cost model and revaluation model. Is this a choice, or doing revaluation using revaluation model is mandatory? Please comment. Please comment. Revaluation model is a choice or is it mandatory? Yes, excellent answer. It's your choice. It's optional. Definitely, it's your wish. No. Okay. Thank you. Is there any event? Now the next question: is there any event in which you have this revaluation becomes mandatory? You have no option. You must have to revalue. Is there any event in which this revaluation becomes mandatory? Must. Tell me. Don't write yes. I want that event. I want that event in the chat box. What's that event on which this revaluation becomes mandatory? Not impairment. I'm talking about upward revaluation. Impairment is downward. What's that event in which you need to bring all assets to fair value, and that's a mandatory thing? Yes, the first guy gave correct answer. Wrong. Yes. Consolidation. At the time of takeover, when parent company, listen, look at me, you must know this. Even they ask this question in SBR. In SBR question, we need to write this theory. Listen, at the time of takeover, when parent company acquired subsidiary company, this is a mandatory thing. That parent company brings all assets of S company to fair value. Hope you remember the formula of goodwill. Cost of investment. The formula of goodwill is cost of investment less fair value of net assets. Cost of investment less fair value of net assets. Fair value of net assets of S company. So this is a mandatory thing. To bring all assets and liabilities of S company to fair value at the time of acquisition. Is at this time you don't have any choice. Okay, so there is a question in your question bank, Gregory. Gregory, Gregory. In that question, you did take over a company. You did take over a company this year. So that means last year you were alone. This year you are parent plus subsidiary combined. Not getting. Last year parent company was alone, but this year, this year, look at here. This year you have parent plus subsidiary, and you acquired new subsidiary this year. So what happens when you do acquisition? What happens when you do acquisition? You revalue. You do mandatory revaluation. You do mandatory revaluation at the time of takeover. So this year all assets are revalued. This year all assets of S company are revalued. So you need to comment on this as well. You need to comment on this as well in the connect, and you need to connect. If you guys have done that question, Gregory, I would recommend you to do it. Even I always teach in my question videos, this question, Gregory, is there. That's very excellent, outclass question. I hope you are getting my things. I'm not wasting your time. Are you getting? Please reply. Few things which you need to discuss when comparing two entities. Obviously you are comparing company A and company B. You are comparing company A and company B. So don't forget to check the size of the business. Listen, one company's size is very big and one is small. So this comparison is not like with like. Okay, this comparison is not like with like. Do comment on this. Then when comparing this year profits with last year, make sure you're comparing full year's profit. Yes, listen, in this thing came in Gregory. This thing came in that Gregory question. You know, you acquired that subsidiary from mid of the year. You acquired that subsidiary in the mid of the year, and now the CEO is claiming, CEO is saying that after acquisition our profits didn't go up with the good speed, because this year only 6 months subsidiary companies results are included. Wait for the next year you will have full year impact. Not getting. Or if you want to compare this year with last year, then do compare full year things. Don't compare half year with full year. That's not a comparison of like with like. And in the Gregory question, they acquired the subsidiary in the mid of the year, and the CEO was blaming that this acquisition is not fruitful because we didn't see a big improvement. So in response you should write that he's not comparing like with like. Yes, Kaplan Kit, he's not doing comparison like with like. This year only 6 months subsidiary profits are included. So why you are crying right now? Getting. When comparing, make sure you remove one of things. Yes, this is also very important. If I've already told you, if there are one of things, obviously remove it. Otherwise that comparison is never like with like. Be careful. Now this is a very common area, and I think there are few questions of this, that when P company is acquiring S company, I think expand, and one few more questions like this in your exam kit. See, P company is acquiring S company. Acquiring X company means buying the running business of S company. P company acquiring S company means buying the running business of S company. That means obviously P company has to invest millions or billions of dollars or pounds, right? So it's a big decision. So before acquiring parent company verifies that this investment is okay or not. Parent company verifies that this investment is okay or not. Now wait, right now S company already in control of another company. See, we want to acquire this S company. We are this parent company. We want to acquire this S company, and this S company right now in control of another company. So this is very common. Wait, these boys are seller, these are seller, and we are buyers. We are buyers. See, we want to buy this S company and they want to sell this S company. So this is very common. If you have seen the car sale, before selling, normally people do polish, you know, people do artificial polish on the car so that it looks good to the buyer. Okay. So this is very common. So normally before selling the running business, people the seller try to boost artificial sales, reduce artificial costs, show extraordinary profits in order to get the highest price, in order to get extra price. Okay. So as a buyer, as an intelligent buyer, we should investigate. As an intelligent buyer, we should investigate that we are paying the right price and we are buying the right company. Okay. So there must be some, I'm using a word, related party transactions, or an easy word, we can say family transactions, family transactions. For example, this subsidiary company, this subsidiary company, which is not in my control right now, is, see, S company has already taken interest free or low interest rate loan from existing directors. Right now, S company is under control of another party, the other directors, and those other directors have given interest free loan to this S company. Why they gave interest free loan? Because right now they are owners, they can give. But once we will acquire the shares, they will no longer be the owners. So they will remove this interest free loan. So then we have to take normal loan from the market. Then we have to take normal loan with current market interest rates. So this will affect this company's performance negatively, because now there will be an interest expense in the company's books. Now after the takeover, there will be a finance cost, interest expense in the company's books. May be possible. See, S company buying, read this point, please cooperate. S company buying raw material from existing group members at a discount, but this discount will vanish once we take over S company. For example, S company makes tube lights. And for tube lights, they buy glass from the same family. S company produces and sells tube lights, and for tube lights they buy glass from the same existing group of companies. So within the group, normally people gives discount. Within the family, within the group, normally people gives discount. Okay, so that means they are buying, their cost is understated. As they are availing discounts, that means their costs are understated. But once we will take over, this thing will be removed, these discounts will be removed. So the future performance will not be the same. The future performance will not be the same as was in the past. So you need to take care. It may be possible, yes, it may be possible that S company's major customers were from the existing group contacts. Yes, it is possible that we are buying a company and that company's major sales are within the group sales. And once we have taken over, that company will no longer be part of that existing group. So all customers will run away. So that means your investment will be worthless. It may be possible S company is dependent on employees. Yes, there are hospitals, there are schools, there are colleges, there are institutes dependent on teachers, hospitals dependent on doctors. What if we acquire that hospital and all major doctors run away? So you need to verify the contracts of employees, that whether there are binding contracts, whether the employees are happy or not. So these things matters. Are you getting? Now, some I always recommend you, and I always now I beg you to read examiner reports. I can show you. See, I also read the examiner report. See this. Can you see in the camera? This is something outclass. This is something next level. And you know the reasons of failures are given in this examiner report. You guys only practice past paper exam kit, you don't focus on examiner reports. There are many techniques and there are many reasons of failure given in this examiner report. So please do read of last 2-3 attempts. And you know, this is the routine habit of position holder students. Position holder students normally read examiner reports. This is a must thing. Now listen, as per recent examiner comments in analysis question, student write brief points. Try to explain it in bit detail. Don't forget this. See, yes, this is also recommended by we teachers that don't don't do extra things. Don't write extra irrelevant things. Irrelevant things won't give you marks. If you do irrelevant discussion, no marks. Be clear. But yes, relevant discussion may give you marks. You will get marks from relevant discussion, but write things in detail, proper. Examiner recently has written this, that you just make few pointers. You don't elaborate. You don't give reasons for that. Okay. So don't be so brief that examiner becomes brief in giving marks. Okay. Try to connect ratios movement with the given scenario. I've already told you that the connection is must. Each and every question is different, and speak according to the question. Speak according to the question, right? Now, this is very outclass point. Outclass. This is something very outclass. Wait, Azan. Okay, let's take a short break of like 7 minutes. Okay, then we'll come back. Okay, welcome back. Now, we were on this point. Listen, try to connect the, I've already, don't just learn the movements. There are students who just learn few movements and they try to fix in each and every question. They try to fix those learnings in each and every question, which is not appropriate at all. Wait, giving you example, your examiner, your marker has written this example. See, try to comment on movements with reference to scenario. For example, students, look at here, students simply comment on increase in inventory as lack of ability to sell goods. Just think, in the question you have seen that inventory is increasing, so you simply wrote one line. You said company can't sell the goods without looking at the sales revenues movement, that sales revenue has already increased a lot. See, neglected the fact that there had been significant increase in revenue in the same question. So this comment is totally irrelevant. Examiner will easily understand that you don't have knowledge. You are not a practical guy. You are not fit for the practical things. You just want to fit ready-made commentary in each and every questions. And yes, I've got many messages. I have got many WhatsApp messages of students. They say, just tell us simple technique how to do ratios. Just tell, and this is the practice of market as well. Many students do this. They just want ready-made things. They just want to learn things. But try to understand, each question is different. So you cannot fix just same commentary in each and every question. This is part 2 level ACCA, part 2 F7 level. This is not A levels paper. Are you getting? Did you understand this example? And this thing is written in the examiner report. You can verify. Your examiner has written this thing. One more thing. There was a time back 7-8 years back. In one attempt, I taught F9 paper. F9. Now I don't teach, but 7-8 years back, I taught F9 paper just for 6 months. So I remember I was doing the past paper of F9, and I wrote this thing from that past paper. But this is equally relevant for your paper as well, because the ratio things is almost connected. Listen, you know this type of basic accounting, all of you know this, that ordinary dividends are distributed from revenue reserves like retained earning. Ordinary dividends are distributed from revenue reserves. We all know this. Now listen, let us say in the question there is a big balance of retained earning. In the question there is a big balance of retained earning in the question, right? And it is also written in the question that shareholders are not happy with the company because company not giving any dividend. So what you did as a student, as a stupid student, you just simply wrote, sir, directors should distribute all the retained earning. Directors should distribute major retained earning to shareholder in the form of dividends. Neglecting the fact without looking at the cash balance. Many students think that dividends are just distributed from retained earning. No. For dividends, you must have cash also. If you want to give cash dividend, you must have cash. Wait. Let me tell you the double entry. Hope you remember the double entry. Is retained earning debit. For dividends, this is the entry. You guys are F7 student. You do final accounts as well. For dividend, this is the entry. Retained earning debit and cash credit. This is the entry for retained earning. So you must have both things. You must have retained earning as well as cash. Just think, in the question you wrote the commentary that directors should distribute these retained earning in the form of cash dividend without looking at the cash balance. Not getting. My dear student, company does not have cash in the balance sheet. There is overdraft. Let us say there is bank overdraft. So how will you give cash dividend? So this is the double entry: debit retained earning and credit cash also. Cash is also included. So don't learn blind commentaries. Use your common sense and be active. Try to learn the techniques. Now, also, listen. Also try to try to read the real life environment as well. You must have some business sense. I know there is a SBR level and professional level is bit higher, and that paper SBL SBR, they require more practical knowledge. Definitely they require a lot practical knowledge, but still, from if you read the recent examiner report, they have started writing this thing that we are preparing you for SBR, we are preparing you for SBR paper. So they start giving some sort of questions of SBR as well. So you must have some practical knowledge, some what is going on in the economy. Like this year, this is COVID-19 thing. So COVID-19 things may come in your exams. The connections may come in your exams. Just like recently you have seen the news of vaccine. The news of vaccine, we all have heard that the vaccine is about to complete. So the day they announced the vaccine news, technology tech stocks went down. Tech stocks went down, like Amazon and like Zoom, and they all went down. Why? There is a connection. You must know the connection, because when vaccine comes, coronavirus will be clean bold. There will be no more coronavirus, inshallah. So things will back to normal. When things will back to normal, people will stop using the technology things. They will stop using the online and all these technological thing. They will go to the physical mall. So automatically the Amazon products, online shopping products demand will go down. The routine life will come up. Automatically the cinemas, people will start going to cinema. So automatically they want watch more movies on Netflix and Amazon Prime and Disney and all these stuff. Are you getting? So you try to understand the real life connections as well. Yes, excellent point. One more routine techniques. This is also very routine. Try to include what if commentary in the solution. And I have seen and I have taught many times this commentary. For example, this year you have a one-off penalty, or you have a one-off impairment, one-off accident, or one-off bomb blast, any one-off thing in the question. Okay, so you need to present this picture as well. You need to present this picture as well, that if this won't happen, if this event won't happen, this loss, this disaster won't happen this year, then we would have been at this place. Try to show this picture as well. So in this way you can predict the future. In this way you can predict the future as well. Wait, giving you real example of company. See, there was a question in exam question bank. I think it's Tabba or something. I forgot the name. Sorry. In that question was SOCF, cash flow question, statement of cash flow question. Listen, come in that question. Please look at me. Be very careful. In that question, company bought a factory of $12 million. $12 million. Okay, so that's a big outflow, huge cash outflow on the factory, big on investing activities. Now, we all know when there is an outflow, definitely there must be inflow to manage it. Company is spending $12 million. That means company must have arranged this $12 million from somewhere. So how to make the connection? See, in the same question, we had operating activities cash flows of 6 million, positive cash flows of 6 million. Company took the loan of 4 million and company issued shares. Company generated cash by issuing shares of 2 million. See, so this is simple connection. 2 million from ordinary shares, share issue, 4 million from loan, and 6 million company generated from operating cash flows. So 6, 4 and 2 makes 12 million, and company invested that 12 million. Company invested that 12 million in that factory. Now we all know that buying factory is a one-off thing. After many years, we buy factory. After many years, we buy such a big factory of $12 million. So just close your eyes and think, go to the next year. Next year, there won't be any capital expenditure like this. So there won't be, see, there won't be no 12 million. There won't be no 12 million outflow first. Next year, we won't issue share. We won't issue new shares. Share issue is also not done every year. We won't take new loan next year. But one thing, next is continuous thing. This, you know, this dialogue. Have you heard this dialogue before? Operating activities are ongoing activities. Routine activities. Operating activities are ongoing activities. They are routine activities. So if we have operating cash flows, positive operating cash flows of 6 million, next year we'll have the same around same 6 million cash flows. So next year when there will be no more this fixed asset expenditure, no share issue and no loan note, this 6 million will be idle cash. We'll have free cash of 6 million next year, and through this cash we can repay our loans and overdrafts and everything. Through this free cash, you can comment that we can repay our loans and overdraft and everything. So this is what if commentary. You start predicting the future. Did you understood this point? This was technical point. This was a technical point. Did you understand, my dear students? So do connect like such things as well. Giving you 1 minute to read. 1 minute to read. Yes. Now try to prove. I sometimes say students in my class that when you're doing a ratio analysis question, even examiner follow this approach. You think like a court case. Have you seen lawyers, how they prove their point? How lawyers prove their point through multiple evidences. This way you have to gather your evidences like a lawyer. Like a lawyer, you have to gather evidences. Now see, try to prove your point of view. Try to prove your point of view with multiple evidences. For example, you have seen that companies performance is going down. You have observed that companies performance is going down. Okay. Now prove it using multiple evidences. You can prove it through sales, that sales is on decline, right? You can prove it through different profitability ratios and few more techniques. Wait, in a question, this was a real question. Company was in loss and or very low profit. Your in the current year, your company was in loss or very low profit. But last year income statement was not given. This year company is in low profit, but in the question, last year income statement was not given. Now, how can you calculate the last year profits? How can you predict the last year profit? What happened in last year? It's not given in the question. So you need to dig out. You need to dig down. You need to dig down that information. How can you dig down? Through balance sheet. Through balance sheet. Now wait. Let me give you something. So you cannot directly check last year company. You cannot directly check that last year company was good or bad. This year company's profits are low or in loss, but last year's performance is not given in the question, openly not given. Last year's performance not given openly in the question. Income statement is not given. Okay. Now, but opening balance sheet is given. Opening balance sheet is given. So what we can do? We'll we'll go in the opening balance sheet and we'll see the tax payable amount, opening tax payable amount. See, in the question, question opening SOFP was given, and there was, now real point, there was a big tax payable there. There was a big taxpayer in the opening balance sheet. So this year's opening balance sheet means last year closing balance sheet. This year's opening balance sheet means last year closing balance sheet. And last in and if in last year's closing balance sheet there is a big, if there is a big tax payable, that means company earned a lot. Company earned a lot last year. That's why company has to pay. Company has to pay a big tax this year. So this is an evidence that company earned a lot. But if you go, but this year and SOFP, a very little amount of tax payable is there, or even tax receivable is there. No, you are not getting. In the opening SOFP, there is a big tax payable. This is an evidence that last year you earned millions of dollars. That's why you have to pay a big tax. But at the end of this year, in the closing SOFP, there is a very small amount of tax payable, or we can say a tax receivable. Tax receivable means when you are in losses, tax department gives you relief. When you are in losses, tax department gives you relief. So you can easily prove through tax. You can easily prove through tax that company is going down. Company is going down. So there are many techniques through which you can prove the performance of company, and you have to go like a court case. You have to gather evidences to prove your point of view. Did you understand? Did you understand? Today you guys have to give me tip as well. I'll tell you what's the tip. You'll have to tip me. Now, this, I want to give you a very quick recap. A very quick recap. Sometimes, listen. There is a perception of market that only 3 topic may be tested in last 40 marks: final accounts, consolidation, and ratios. They ignore cash flow statement. That's their biggest mistake. In last 3-4 recent, I'm talking about the recent last 3-4 years, I have seen many students, they got 20 marks cash flow, statement of cash flow. It's equally important. Yes, it's not in fashion. We can say this, it's not in fashion, but it may come. It's part of your course, and there is no choice in your course. Just think, if it comes of 20 marks, you will be speechless. You won't be able to do anything. So yes, it's a small topic, but do it. At least 2-3 questions, do it, right? For safety. Now, if you get SOCF question and theory question, there are 3 activities: operating, investing, and financing. Always remember one thing, that this is the heart of company. Operating activities are the heart of companies. Why? Because operating activities are ongoing activities. But investing and financing, they may be one-off activities. Like, for example, you bought a big factory this year, so there will be a big outflow in investing activities. So no issue. Shareholder won't mind the negative. Shareholder won't mind the negative cash flow of investing activities, because investing activities are one-off. Financing activities are also one-off. For example, this year you took a big loan. So there will be a big inflow. There will be a big inflow in financing activities, but that's not a sign of good performance. Because if you are taking loan, what's your contribution? You are just taking loan, somebody else's money. So financing and investing activities are not that much important. But operating, yes, if you are earning from operation, that's great thing, because operations are the things for which organization is made for. Just think, that's your primary activity. So obviously, if in the question operating cash flows are positive, you should comment positively. But if operating activities are negative, then you should comment negatively. Okay, right? Because all these activities are ongoing, and plus these are the activities for which organization is made for. Don't forget. Now, this is one more example. Sometimes you need to dig down things for finding the reason. Example from past paper. Yes, this is a little difficult. I agree. Listen, I forgot I think the name of this question was Victular, VIC. Very old question, I think 10 years old, 10, 12 years old question. I don't know if this is in the kit right now or not. Victular. Now, there were two companies. In the question. Listen. You will learn new thing. There were two companies, A company and B company. A company used to buy assets on ownership. That means for paying cash and buying assets. Okay. So when A company bought asset, listen. Maybe this is possible that there is a government there. Listen. Government has offered a policy that government has given offer that whoever will buy that asset, will buy that asset will get the government grant, uh, from government. Okay. And what's the evidence in the question, in the balance sheet of A company? In the balance sheet of A company, there is a government grant deferred income. There is a deferred income there. There is a deferred income liability was there in the question. I repeat, there were two companies, A company and B company, and you have to identify which one is better. You have to comment which one is better. A company believes in buying assets, and when A company when A company buys the asset, let us say government has given the offer that whoever will buy that asset, government will give that company government grant. Okay. And what is the evidence? The evidence is in the balance sheet. In the balance sheet of A company, government grant is there. The deferred income liability of government grant is there. Okay. Now come to B company. B company, B company doesn't buy asset. They take assets on lease. They take assets on lease. That means B company is a lessee. Please, B company is a lessee, and there is one more party, other party. That party is lesser. B company never buys directly asset. B company simply lease the asset. That means B company is lessee, and there is one more party which is lesser. And now, wait, the real game. Now in the question it is written. That lesser has given discounted interest rate. For example, the market interest rate. You remember the finance lease. In finance lease, there is an interest rate. In finance lease is like a loan. Finance lease is like a loan. For example, in the question, market interest rate is 10%, but lesser is just charging 5% interest rate. Lesser is just charging 5% interest rate. Again, I repeat, in the question it is written that the market interest rate is 10%, but lesser is just charging 5% from us. So one can think, student can think, why lesser is giving discount? Why lesser is giving discount to us in the interest rate? So there may be one reason for this. Listen the reason. Maybe lesser, as now lesser will buy asset for us. Lesser will first buy asset, and he will provide it to us. So as the lesser is directly buying, so it is possible that government giving grant to lesser, government giving grant to the lesser, and because of us, yani because of B company, means because of B company, lesser has got this grant. So that's why lesser is transferring some benefit of grant to us. Lesser is transferring some benefit of that grant to us in the form of reduced interest rate. In the form of reduced interest rate, this may be the reason of this reduced interest rate. Did you understood? Boys and girls, please. This was a technical point, very technical point. See, A company directly bought asset. That's why in the A company's books, government grant is there. But in the B company books, there is no government grant liability. Why? Because B company does not buy assets. B company takes assets on lease. So that means the lesser is the guy who buys the asset for us. So that means lesser may be getting government grant, and as the lesser getting government grant because of us, that's why he is transferring some benefit to us in the form of reduced interest rate. Yes, somebody has written it's a technical commentary. A normal person can't go there. If you can't do this in exam, no issue. Don't underestimate yourself. This is a very difficult commentary. But yes, listen one thing. If you do past paper, or if you do exam kit question, exam kit means past papers. If you do exam kit past paper questions, after doing question, go and read the examiner solution or past paper solution. You must understand that past paper solution. I know you can't write to that level, you cannot write to exactly to that level, but at the time when you are reading the solution, you must understand at least you should achieve this level. But don't expect that you can write exactly as examiner is writing. No, that's not possible, because that's a very professional solution, and two, three experts, they write that solution. One guy writes the header, guy writes the conclusion, and that's a separate thing. Okay. Giving you 30 seconds to read it. 30 seconds. Come on, 30 seconds. Now, I sent you one questions folder yesterday. I sent you one questions folder yesterday, dear. So in that question, this is a very latest past paper. Even in your recent examiner report, examiner used the name of this company to practice this. In the recent last July 2020 examiner report, it's openly written, examiner recommended, marker recommended this question to practice. Okay, that's why I've taken this question. Now, not difficult at all, just you have to follow the correct path. No need to get nervous. Go slow, you will understand. Okay, right? Now, uh, I assume that you have the question, and if you don't have the question, still you can see the screen. Okay, I've already sent you, or I sent you again in one click. It's one click for me. Wait. Now, fit company and sporty company Fit company and sporty company both operate in sports wear sector. Okay, they're dealing with sports products. Okay, extract from the draft financial statement for the companies for the year ended 31st December X0. are as follows. See, these are obvious things. See, the Fit company's actual sales is higher as compared to Sporty company. Okay. The reason maybe for this difference is the size of the company, or the reason may be that Fit company may charging less prices, so they are dealing in quantity. They believes in quantity sales, right? Whatever the reason may be, but just as a first thinking, as a first thought, I'm saying this. Now you have cost of sales, gross profit. Now what thing what thing you find one off? There is a one off thing. There is a one off thing, looks one off. See, there is no gain, but here there is a gain on disposal. See, this is one off thing in Fit company, but this is not in Sporty company. Okay. Now operating expenses, profit from operations. Yes, one thing is very obvious. In Fit company there is a very big finance cost. There is a very high finance cost. See, finance cost is high. Here the finance cost is low, so definitely looks like that Fit company is highly geared, or we can say Fit company has taken lot of loans. Okay, this may be possible, and we can see, we'll prove it. Now the final profits. But one thing is clear right now. This profit from operation is also called PBIT. This profit from operations is also called PBIT. But right now PBIT is 25,000 and this is 7,500. So Fit company has enough profits to cover this finance cost. Enough profit to cover this finance cost, right? Okay. But now this is the draft statement of financial position. See, they have not given you the complete balance sheet. They have not given you the complete SOFP. They have just given you some pieces. They have not given you the complete SOFP. They have just given you pieces. Okay, the extract. Now cash 5,000, here 10,000. Equity, non-current liabilities. See, their liabilities are lower, their non-current liabilities are lower, right? Okay. Then trade payables, and this trade payables, this trade payable is significantly higher, and I'll prove that Fit company is not able to pay. Fit company not able to pay its creditors on time, right? That's the issue with Fit company. We'll prove it. Now one thing, just a discussion. Company has cash balance of how much? Company has cash balance of 5,000. Fit company has cash balance of 5,000. And what's the finance cost? What's the finance cost of Fit company? It's 7,500. So if we see things in terms of profit, if we see, look at the Fit company only. Fit company, if we see Fit company in terms of profits, so yes, Fit company has enough profits, have enough profits to cover the finance cost. But when it comes to cash, because you have to pay, you have to pay the finance cost as well in the form of cash. You have to pay the finance cost or interest expense in the form of cash. Then your finance cost is 7,500, but your cash is only 5,000. So you don't have enough cash. You don't have enough cash to pay to settle this finance cost. So in the long term you will have more problems. In the long term you will have more problems. This thing you can connect. This thing you can connect. Okay. Now let's go. Let's read the question. Fit company Fit company is the manufacturer plus retailer. Two things. Not only they, look at it. Fit company not only manufactures, but also they sell it. So they have two units. The manufacturing units they are running themselves, plus the retailing thing they are doing themselves. Both things. Of premium branded sportswear. See, their products are branded products. So just a thought, one second thought, branded products are normally expensive. We all know this. When it comes to brand, the price is always high. When it comes to brand, the price is always high. Yes or no? So in one click I can assume that their prices are high, and when selling prices are high, they should have good GP margin. They should have fit company should have good GP and operating margins, because they are dealing with branded products. But let's see if this is the case or not. Let's see. But as a common man, what things come in my mind? High margins, branded. Now, and they also sell online and in its own international chain of branded stores. Now wait, they have their own branded stores. They are owning the brand. They are owning or renting. They are running their own branded stores. So just think, they have to pay the rent. They have to pay the overheads. They have to run the whole store themselves. So it's a big cost. Okay, so there is a possibility in this line. I have judged many things there, that their fit company's cost structure is higher, expenses may be higher. Right now, the other company is Sporty company sells mid market sportswear in departmental stores and online. See the game. You have seen the big department stores, and there are different racks of different products. So what? Sporty company, they don't own any shops and something. They just use departmental stores, and they supply the products to departmental stores so that they can sell. So in this way, their cost structure may be lower. They are not running their own branded stores. It sources its goods. Now, fit company was the manufacturer. They are doing manufacturing themselves. Now what? The Sporty company, it sources its goods directly from the manufacturer and does not make international sales. See, they they don't manufacture. They like they are doing it like middleman. They just buy ready-made goods from a manufacturer, and they just transfer it to the departmental stores and they sell it. So that means, in this way, they can save many of their manufacturing overheads, manufacturing cost, right? So there is a possibility their cost structure is different from fit company. This point you can raise. Now, Sporty company plans to expand into international markets during the next financial year. That's their plan to expand, but for they need finance. They need finance. Okay, for this thing they need finance. For this thing they need finance. Okay, now, and for this finance we need to comment that how they will generate. There is there any possibility of good finance they can arrange. Now, on 31st December x0, that's the last day. Wait, your accounting period is in the question. Wait, yes, your accounting period in the question is, look at the screen. In the accounting period in the question is 1st January x0 to 31st December x0. Now, on 31st December x0, that's the last day. Fit company disposed of its investment. Very scoring point, the heart of this question. Fit company disposed of its investment in the active division. That means they sold their running division active for consideration of $10 million. The cash proceeds have been recorded as a receivable at the date of financial statements were prepared. That means one extra point is coming in my mind right now, that this 10 million will be received shortly. So this 10 million will add to your future cash flows. See, they have right now 5 million cash with them. They have right now 5 million cash with them, but soon they will receive another 10 million. So that's maybe a little short-term positive point for them. Okay. In the short term, they might get this 10 million. Okay. Right now, the gain on disposal. See, After many years, a company sells the division. Normally, selling a division is not a routine thing. Selling a division is not a routine thing. So after many years, company sells the division, right? So the active division had the following ratios. Sorry. So there is a gain on disposal is included in the statement of profit and loss. Now, what do you think? This gain on disposal is a routine thing or one-off thing? Comment, please. Comment, please. Write on the chat box. This gain on disposal is one-off. Very good. Very good. One-off. Now, listen. What this gain on disposal did? This gain on disposal ultimately increase your PBIT. This gain on disposal ultimately increase your profit from operations. So when this gain on disposal increase your profit from operations, so your operating margin will be higher. Your this year fit company's operating profit margin will be artificially higher. So we will say this openly that this operating margin is unreal. If you use the numbers given in the question, if you use the numbers, the profits given in the question, then these profits are artificially overstated because of the inclusion, of this one-off thing. Okay, one more one-off thing, one more very excellent thing you have. I hope you all have studied IFRS 5, non-current asset held for sale and discontinued operation. Non-current assets held for sale and discontinued operation. Listen, in that discontinued why IFRS 5 says to report to do a separate presentation of discontinued operation. Why IFRS 5 says to write discontinued operation in the SOCI a separate line, so that why? Because so that shareholders won't expect any extra profits next year, because we have sold the division, we have sold the running business. So this business will no more be with us next year. This business will no more be with us next year. So that's why people won't expect anything from that. That's why we write in a separate line. Okay, now listen. The active division, see, the active division means the one division, the division which we just sold, active division we just sold on the last day, had the following ratios for the year ended 31st December X0. The separate standalone ratio of GP margin is 40%, operating margin is 5%. Let's see, we'll compare this ratio with the overall ratio of fit company. This is the separate, these are the separate ratios of active division. Now fit company also charge 100,000 per month. 100,000 per month means 100 multiplied by 12. 100 multiply, there are 12 months in a year. That this will become 1.2 million. 1.2 million per year, and 1.2 million in our language is 1200. If normally we remove three zeros, so it will become 1200. So fit company also charge 100,000 per month, that is 1.2 million per year, to the active division for central services, which was deducted from operating expenses in the financial statement. This was the routine income. This was the routine income of fit company. This was a routine income of fit company from this active division. But now just think, from next year this income will be no more. From next year, as we have sold that division, so from next year we can't avail this opportunity. Next year we won't have this income. So now just think, what is the treatment? Read the treatment. See, which was deducted. Can you read this line? From operating expenses. That means You sold it at the end of the year. You sold this division at the end of the year. That means this year has passed. That means you earned this income, this 1.2 million you earned this year. And when you earned this year, you deduct it from operating expenses. So your operating expenses are lower. In the current year, fit companies operating expenses are lower because of this. And when your operating expenses are lower, your operating profit is higher. So again, we can comment. Again, we can comment that your operating profit next year will go down with speed. With speed. Why? Because next year, two things won't be with us. Next year, there will be no gain on disposal. I'm talking about fit company. With fit company, next year, there will be no gain on disposal. There will be no gain on disposal. Plus, next year, there will be no more this income, no more this 100,000 per month or 1.2 million per year income with us. So just imagine the bad phase of next year. Next year, fit company's profit will go significantly down. Next year, fit company profit will go significantly down. Are you getting? Now, the first, there are some free marks. There are always some free marks in the question. I say this to my students, that scoring 50, examiner gives 50 marks separately in the exam. It's hidden. You have to collect it. 50 is not a big deal if you are active. Now listen, the first 6 marks, use the financial statement extract provided, calculate the following ratios for both fit and sporty. You need to compute GP margin, operating margin, trade payable days, ROCE, return on capital employed, ROCE, right? And gearing with debt equity, debt upon equity. Listen, there are two formulas for gearing. The first one is debt divided by debt plus equity, debt divided by debt plus equity. But now here examiner has clearly written the gearing formula. So now you have to follow debt divided by equity. One more thing, this is a very routine transaction. It is written on in the examiner reports as well, that if examiner is guiding you to use a certain formula, or examiner has shown you a calculation of ratios, then follow the formula of examiner. No need to follow the formula of teacher and book. Okay? If examiner has guided you to use a certain formula, then strictly use the use the formula given in the question. Don't follow your teacher, don't follow the book. Okay? But this is a very generalized, ratios working is very easy. Okay? So now, first of all, I've already sent you the question. If you don't have question, wait, take a take a picture from here. Take a picture from here, or it's available on accaglobal.com as well. It's available on accaglobal.com as well. Okay. Now, first of all, how do we calculate GP margin? Very simple. No tension. No, it's free marks. This is your GP. C. This is GP. This is sales. C. This is sales revenue. This is GP. So how we'll do GP divided by sales into 100. Here 70 divided by 70 70 divided by 220, and here we'll do 60 divided by 250. So it's not a big deal at all. Okay, GP margin is simple. Now, how are we going to do operating margin, operating profit margin? The formula for operating profit margin is PBIT divided by sales into 100. So this is your PBIT. C, profit from this C. Wait, this is your PBIT. This is your PBIT. So PBIT is 25,000. Sales is 250. So PBIT upon sales, PBIT 25,000. Sales is 250,000 into 100. Similarly, Sporty company 32,000 divided by 220,000 into 100. Right? right? Now let me show you these two ratios. I have already computed it because our time is very important. Listen. How GP margin is, see, GP margin is GP, GP margin is GP upon sales into 100. See this, not a big deal. Operating margin is operating profit upon sales into 100. Yes or no? Now, trade payable days. Trade payable days. What's the formula of trade payable days? Simple. Closing trade payables divided by cost of sales into 365. Closing trade payables divided by cost of sales into 365 into 365. Okay. So here you have 67 days and here you have 29 days. Again, see, fit companies. Wait, let me write the heading. This is fit. This is Sporty. Okay. There is a question, sir, we have not to adjust the profit on disposal as note number. No, read the requirement. There are questions, I have seen these such questions in the exam kit past paper, in which examiner instruct you to remove it. Then you remove it and calculate. There is no such requirement. You can check, go and check the requirement. Now, three ratios done, very easy. Now the fourth is return on capital employed. Return on capital employed is PBIT. What's the formula? Wait, let me write the formula first. The formula of ROS is PBIT divided by capital employed. And what is capital employed? Capital employed is equity plus debt, equity plus loan, okay, into 100. See, the formula of return on capital employed is PBIT divided by capital employed. And how do we calculate capital employed? Capital employed is equity, shareholder equity plus long-term loan notes. So look at the screen. See, for fit company, this is equity 90,000. 90,000 is the equity and 45,000 is the loan. 90,000 is the equity and 45,000 is the loan. So if you add 90 plus 45, if you add 90 plus 45, you will get the capital employed. And for this company, see, for this company, 60 plus 15, 60 plus 15. Now, sir, are we given ready-made PBIT? Yes, this is your PBIT. This is your PBIT. 25 and 32. 25 and 32. You have a look, please. Now, see this your PBIT. Look at the screen, please. Your PBIT is 25,000 debt plus equity into 100, 18.5%, 18.5%, and this is 42.7%. Now, the last thing is gearing. In this question, the gearing formula is debt divided by equity into 100. For this question, for gearing, we need to calculate debt equity ratio. And how do we calculate debt equity ratio? That is debt divided by equity into 100. Debt divided by equity into 100. Okay. So see this. Your debt, your loans are 45,000, your equity is 90,000 times 100, 50% gearing. And your here you have loans of 15, equity of 60, so 25% gearing, right? Okay. Can you see the screen? Can you see these points? Yes, I'll send this file. Don't worry. I'll send this PDF file to you guys. Don't worry, don't worry, don't worry. You just concentrate on the topic. Try to learn things, understand things. Okay. Now, just let's start discussing the commentary, and then we'll read it. Then we'll read it how to write. Okay. No, not a big deal. Not a big deal. Listen. First of all, in the your GP margin for Sporty companies 31 and Fit companies 24. Now use your brain. Higher GP margin means just speed two things. The reasons of high GP margin means maybe higher selling prices, maybe Sporty companies price selling prices are higher, or Sporty's companies cost is lower. Sporty's companies selling price is higher or cost is lower. You can write that they may not be facing any competition, that's why Sporty company may charge high prices. And yes, for the cost there is an evidence, for cost there is a real evidence, you can do connection. Sporty company, listen, look at me and listen now, that's important area. Sporty company is not involved in production, is not involved in production. They are directly picking things from manufacturer and supplying to departmental stores. So that means they can save a lot of manufacturing costs, lot of manufacturing overheads. That's why their costs are lower, that's why their GP margin is higher. Number two, if you come to fit company, hope you remember the lines, the question in the fit company. Look at here, in the fit company it was clearly written, in the fit company's lines it was clearly written that fit company is a brand. Fit company sells through a branded shops. So with brands, the prices should be higher. With brands, the prices should be higher. So the GP margin, the prices should be higher. So the GP margin. But the picture is totally different. But the picture here is totally different. Their GP margin is lower. They have lower GP margin compared to Sporty, despite the fact they are selling using branded names, branded stores. They are selling through branded stores. So what may be the reason? Two reasons. The first reason, their cost may be higher. Their cost, because they are involved in manufacturing, so manufacturing overheads, and plus they are selling through branded stores, so the cost and overheads of branded stores and all, the cost. And number two, maybe possible they are facing competition, that's why they can't charge higher prices. They can't charge higher prices. This is a possibility. This is a possibility. Are you getting? Now one more thing, listen. Right now, please, right now fit companies results includes that active division. Right now fit companies results includes that active division. And after, listen to me, after including fit company, after including active division results, the GP margin is 24%. 24%. After including, after adding active division results, the GP margin is for 24%. Can you see the separate? Can you see the separate? See this? Can you see the separate GP margin? Can you see the separate GP margin of active division? That is 40%. 40% alone. But with fit company, when you average it out, it's 24%. So that means the remaining divisions of fit companies are not good. That means for sure the remaining divisions of fit companies are not good. And in future, when this active company will no more be part of us, so there will be a big decline. There will be a big decline without active company, without active division. Because right now with active division we are already at 24. Right now with active division results we are already at 24%. So just imagine the next year without active division we will be not getting. Are you getting? So this point you have to write. Now, then then come to operating margin. See, operating operating margin of Sporty is higher and fit company is lower. So one easy commentary which normally I even taught you that the reason of low operating margin of fit company is low GP margin, because when GP margin is lower, operating profit margin will also lower, because operating profit follows GP. Operating profit follows GP. One reason. Operating profit follows GP. One reason. The second reason, there is a possibility that Sporty companies lot of saves lot of operating cost. Sporty company saves lot of operating cost because they are not involved in manufacturing, no rent. They are not selling through branded stores, they are just selling through departmental stores. So they can save their operating cost. But with fit company, they maybe their operating costs are higher. And one more thing, fit companies operating margin is looks totally artificial because fit companies operating profit in this year fit companies operating profit includes two things which will be no more with us next year. The first is gain on disposal. And the second thing is that annual income of 1.2 million, annual income of 1.2 million, which will be no more with us from next year. So next year this will fall drastically. This will for sure fall drastically. This is artificial, we can't believe on it. Now if you come now, these are the performance. See, profitability ratios are normally, profit is for the year thing. Look at me. Profit is a for the year thing, for the year. And for the year ratios are normally performance ratios. And balance sheet is as at thing. Balance sheet is as at thing, right? So gearing and all these are financial position ratios. One thing is listen, one thing is performance ratios and one thing is position ratios. So those ratios which are normally connected with the SOFP, they are position ratios like gearing and all. Okay. And profitability ratios are performance ratios. Now look at the rows. This rows is 42.7 and this is 18.5%. What is the routine commentary of rows? What rows shows? Rows shows the efficiency of management. Rows shows the overall efficiency of the management. So by comparing these two, the efficiency of fit company is lower and the efficiency of this company is higher. Simple. Now one more thing, hope you remember I told you one formula. Rows is the product of asset turnover and operating margin. You remember I taught you today. Rows is the product of asset turnover and operating margin. So listen, as the operating margin of this company, of fit company, is lower, that's why ROS is also lower. Repeat, one of the reason of low ROS is low operating margin. That's why ROS is also lower, right? Okay, so you can write these things. Now you will ask one thing, sir, you taught us about the carrying value of assets. You taught something about today before the break. I taught you something about carrying values of asset to comment on carrying value of assets? Dear students, right now in this question, no carrying value of assets are given. No carrying value of assets are given. So you are not able to comment on that area, right? Okay, you are not able. Now, then if you come to performance ratios, the first ratio is the famous ratio is gearing. Now, what do you mean by high gearing? High gearing means, listen, this lecture is the real lecture. Whatever I'm telling you right now, this will be written in the solution. Okay, the real thing is right now we are doing the real part. Now, listen. High gearing means company is full, company has taken a lot of loans. The loan burden is higher on company, and the less geared company means loan free company, or the company with less loans. Okay, so now what high gearing shows? High gearing means high financial risk. High gearing means high financial risk. You have to say this in the question, you have to write. So that means financial risk of fit company is higher than financial risk of sporty company. Why the financial risk is higher? First reason, when you are highly geared, that means you have taken a lot of loans, and loans are always comes with a repayment date. Loans always have a repayment date, so you need to prepare yourself for the repayment. You need to prepare yourself for the repayment. If you don't repay loan on time, your company will be vanished. Your company will be no more. Are you getting? So this is the first risk. Number two, when you are highly geared company, when you have taken a lot of loans, look at me, when you have taken a lot of loans, that means high loans means high finance cost. High loans means high finance cost and high interest expense. And you can see I showed you that fit companies finance cost is higher. Fit companies finance cost is higher. So finance cost is a sort of fixed cost. Finance cost is a sort of fixed cost. If you don't do any activity, still you have to give finance cost to the bank. So interest expense is like a fixed financial cost. It's like a fixed cost, right? And fixed cost increases the risk of owner. Fixed cost increases the risk of owner. Even you don't earn a single penny, still you have to pay the fixed cost. So it's dangerous. But now one thing you will say, sir, uh see, fit company has enough profits. Fit company has enough profits to cover this finance cost. Fit company has enough profits to cover this finance cost. Yes, in terms of income statement we can say this. In terms of income statement, this comment is right. But income statement is prepared on accrual basis. Income statements are prepared on accrual basis. Let's go to the cash side. We have this finance cost, and obviously this 7500 finance cost we need to pay. But we have only how much cash? We have only how much cash? The cash is only 5000. So that means when it comes to cash, when it's come to paying of interest in terms of cash, we can't. We may be in problem, right? So that's alarming thing. That's a problematic thing with fit company, which you need to identify. Yes, one more comment somebody told me, but sir, fit company will receive. Yes, that point we may add in the conclusion. Because in the conclusion, the what's the overall theme, right? I have almost read the whole question with you. The overall theme is sporty is good and fit is bad. That's simple. In this whole scenario, sporty is going good and fit is going bad. So you will say a lot of negative comments on fit, and in the end you will say one good thing for fit, that they will receive 10 million soon. They will receive 10 million soon. Yes, you will write this. So with gearing, I have told you 3 to 4 points. Now one more point of excellent point. You know, in the world, in the different countries of world, there is a sometime government, sometime, look at me and listen this point. Sometime government imposes gearing restrictions. Like in past, there was a gearing restriction of 60% in Pakistan. In past there was a gearing restriction of 60% in Pakistan. Means Pakistani company in Pakistan cannot increase its gearing from 60% and above. That's the maximum gearing you can go is 60%. The maximum level of gearing you can go is 60. If you cross this 60 limit, you will be compulsory winded up. You will be compulsory liquidated by government. That means by law you can't cross 60%. That was a law in past in Pakistan. So now just imagine, think. Fit company is already at 50%. Fit company is already at 50%, but sporty company gearing is 25%. So now, if fit company wants urgent money, can they arrange more loans? No. Fit company is already at 50%. Just they can increase 10% if you compare with Pakistan. Existing law. But yes, sporty company can generate extra finance easily, extra loan. So hope you remember there was one line in the point number 2. There was one line in point number 2. Hope you remember. And it was written that Sporty companies has planned to go international. Sporty company has planned to expand internationally. Yes, they can expand through more loans. They have the ability to take more loans because their gearing is already lower. One extra point. Whenever, right now, let us say I need some cash, and I went to the bank to take the loan. So bank bank will ask first thing that have you already taken loan, and if I have already taken a lot of loans, bank will reject. Bank will say goodbye, we can't give you. So if a company is already highly geared, they can't generate more new loans. I hope you got it. Did you understand these points or not? Hello. Now, one last thing. Trade payable days. What's this? Trade payable days of Sporty is just 29 days and it's 67 days. Simple reason. That means fit company cannot pay its trade creditors on time. Or you can say fit company has liquidity issues, and you can prove it as well. You can connect it as well, and the proof is the cash balance. Fit company is running out of cash, has low cash balance. Fit company has low cash balance. That's why fit company can't pay its creditors on time. This is one of the possibility. Then you will say, what will be the consequences? Listen, if fit company continues this behavior, of paying late, so in future these suppliers won't supply fit company goods, or supplier will keep them in bad books, right? That's all. That's the or there will be a bad name. This will create a bad name. This will create a bad name of fit company in the market. These all are the possibilities, right? Now, one more thing in the end. Even I teach this in my class. You know, when you are dealing with ratios, look at me. When you are dealing with ratios, you are not sitting with the directors of the company. Right now, we have just one piece of paper. Right now, we have just one piece of paper. We are not with the directors of the company. We are not with the directors of the company. So we don't know the real reality. We don't know the real reality, what's going on inside the company. We just have a piece of paper and we have to comment. So we can use the language of maybe, can be, like this. So when you have high credit days, that means 1 point. See, I'm coming from another angle. 1 point is that means people trust us more. People, the supplier giving us 67 days credit. The supplier giving us 67 days credit, and the other parties are just getting 29. That means we have more credit worthiness. Are you getting? Or one more example just came in my mind. You know, Walmart. Have you heard about Walmart? You all must have heard about the Walmart, the biggest giant, very big giant in US for consumer goods, all FMCG, fast moving consumer goods. You know, whenever you supply, one few of my relatives, they supply goods to Walmart. Listen, but Walmart has a straight policy. Walmart pays after 8-9 months, 7-8 months. That's their power. Because if luckily you get Walmart as your customer, and you supply goods to Walmart, then you don't have to do teaching. Then you don't have to do anything. Just supply goods to Walmart, because Walmart has a biggest customer base. So this is also one point. Just think that if suppliers are giving us more credit days, that means we are powerful. Suppliers are dependent on us. Suppliers can't live without doing business with us. You're not getting. Did you understand these last points? The Walmart thing. Did you understand the Walmart thing? Now, and finally, after all these comments, you can conclude. The conclusion is very simple. The Sporty company is better than fit company. Sporty companies, listen, Sporty companies, all ratios, the risk profile, everything is better than fit company. But yes, one thing is positive for fit companies, that fit company will soon receive a 10 million cash, which may improve the liquidity, of fit company, okay. So now, listen, I have just written it for you so that we can save our time. It's not my objective, it's to write in front of you, okay. Now, Sporty, see this. Sporty company has higher GP margin than fit company, despite the fact the actual sales of Sporty is lower. No need to forget this fact that the actual sales is lower. Actual sales of Sporty is lower. You can go and check the question. Actual sales of Sporty is just 220,000. Actual sales of Sporty is just 220,000, and actual sales of fit company is 250,000. Right now, major reasons for higher margin of Sporty may be, go normal, higher selling prices, yes, and lower cost. One evidence of lower cost of Sporty is it sources products directly from the manufacturer. In this way, it can avoid extra manufacturing cost or manufacturing overheads. Okay, go slow. Read it, read it. Take your time, take your time. We already discussed it. We already discussed each and everything. Now, now we read these lines. We read these lines that listen, 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 listen. That Fit Company is a branded game. Is a branded game. Fit Company is a branded party. So branded parties are normally expensive. So their margins must be higher, but the things are opposite. But the things are opposite. See, it is surprising that Fit Company's GP margin is lower because Fit Company is selling premium branded goods, and such goods have higher GP margin because they are expensive. See, just listen, listen. Just don't write single line. Try to give the reasoning. Try to give the reasoning. I told you the examiner's report comment. Try to give not only the words, the not only the point, but also elaborate it so that examiner marker comes to know that you know the reality of that point. Now, it may be possible that Fit Company is facing high competition, yes, because of competition. And it is also clear that Fit Company's current, see now the cost side, current GP margin is supported by active division with GPM means GP margin of 40%. Fit Company's overall margin is lower than active division means next year I told you there will be more decrease in GP margin of Fit Company. Okay, one thing I have not written here but I have orally told you, one thing I have not written here but I have already orally told you about the cost structure, which is also a slight point you can write, that the manufacturing cost they are doing their manufacturing by own, may be possible their manufacturing cost is higher, may be possible their manufacturing cost is higher. Read it. Now come to the operating margin. The operating margin of Sporty is 4% higher than Fit Company. We have already seen 14 and 10, 14 and 10, around 14 and 10, right? So the 4% difference. One of the reason of this is carried forward effect of higher GP margin. Yes, because Sporty's company's GP margin was higher, so higher GP margin will give birth to higher NP or operating margin, right? The carried forward effect I told you in the commentary. Then on deeper inspection, on by digging down, it looks like that Fit Company's operating margin is overstated. I told you it's artificial. Fit Company's operating profit included few things which will no more be part of Fit Company from next year, because it includes one-off gain on disposal of 5 million and central service income of 1.2 million. You remember 100,000 multiplied by 12, 100,000 times 12, which will not be available next year. Also the cost, also the cost structure of Fit Company looks higher than Sporty Company. I told you, because Fit Company operates through its stores, whereas Sporty Company works through departmental stores. Sporty Company works through departmental stores. See this? Can you see this? You can read the lines. You can read between the lines. Okay, now a little bit discussion on ROS. See, Sporty company has high ROS, which Sporty company has high ROS, which is the indicator of high efficiency. I told you. ROS indicates the efficiency. I told you. Now, as ROS of Sporty is high because of high operating margin. I told you ROS is the product of operating margin and asset turnover. So as Sporty has higher operating margin, that's why that's one of the reason. That's one of the reason of high return on capital employed. Okay, right? And one more thing, you know, in return on capital employed, in the numerator this is PBIT, in the denominator is equity plus debt. Equity plus debt. If you go and see, if you go and see the equity and debt of Sporty company is lower. So when the equity and debt is lower, when the equity and debt of Sporty is lower, so that means the capital employed is lower, so automatically their ROS is high. Automatically their ROS is high, right? So these are one of the reasons. Now, very easy. Now, if you comment on position, that is gearing and debt creditor days. Now, fit company's gearing is almost double of Sporty company, which means financial risk of fit company is higher. High gearing means high financial risk. I already told you. Please, I already told you. One reason for high risk is now fit company has to do preparation for repayment of this loan. You know, when you have taken loan, there must be a repayment date, and if you fail to repay your loans on time, you will be no more. Your company will be liquidated, right? So this is a risk. Repayment of loan is a big risk. Also, lower gearing of Sporty. I gave you example of Pakistan 60%. I hope you remember it. Means in future Sporty company can easily generate debt finance whenever it wants to do expansion. You remember international expansion. Remember international thing was written. So yes, this company is eligible. Also, high gearing means more loans. High gearing means more loans. Means when your loans are higher, listen, when fit company has more loans, so obviously more finance cost. Means finance cost of fit company is also higher. But right now, fit company has enough profits to cover this finance cost. I already showed you. But if we analyze the same issue with reference to cash, if you see these things with cash, then fit company's current cash balance is less than this year's finance cost. Means fit company may have problems in paying finance cost in the form of cash. See this. You can see. Now, trade payable days are 67 for fit and 29 for Sporty. This clearly shows poor liquidity. Yes, that means they are paying late, and the paying late means poor liquidity. Paying late means poor liquidity, which can be seen in the form of lower cash balance. Yes, you immediately gave the evidence. You immediately gave the evidence that poor liquidity is because of low cash balance, right? If this thing continues with fit, if this thing continues with fit, then in future this will result in poor relationship with suppliers. On the other side, one other side, now let's discuss the better side of this. Higher credit days of it may be good credit worthiness of it. See, when people are giving us 67 days credit, that means people trust us. One reason may be people trust us, or we are powerful like Walmart, or we are powerful people like Walmart. You're not getting. So these are all the sides which you need to reflect. And finally, the conclusion. In conclusion, I have not written conclusion here. You can write the conclusion that that Sporty company overall position and performance is better than Fit company in terms of all ratios, in terms of financial risk. But yes, there is one more positive point with Fit company, that Fit companies will soon receive a 10 million cash so that Fit company can meet short-term commitments, right? Okay, did you understand or not? Tell me. Now the question is over. Right. Did you understand the question? It's time to comment. I wrote each and these all slides I made with my own hands, not from assistant. I wrote this for you guys. So I think this time you should tip me. I deserve some tip. Now listen, my boys and girls, listen. After this question, yesterday we missed one consolidation question. I really want to discuss that balance sheet question so that you understand the balance sheet issue as well, because consolidation is the heart of your course, right? Okay, so let's take a 5 minutes break and then continue with that consolidation question. We'll do it Excel practice, proper software practice, right? Okay, let's take 5 minutes break. Listen, it's better. One of the student asked a question. It's better to write in points, so that examiner can easily give you marks. Just think from the marker's point of view, right? So if you, for example, there is a 10-mark question, 10-mark commentary question, so you can write 10 specific points so that they can give you 1 mark per point, 1 mark per point, right? Okay. So come on, this is the last question of today's class. Be active, please, and we'll do software practice. And don't forget that you guys have to also do software practice, because this is also one of the reason of failure. This is also one of the reason of failure. I'm telling you that you are not used to with the software thing. Now, the scenario relates to two requirements. The scenario relates to two requirements. On 1st April X4, on 1st of April X4, runner company acquired 80% of jogger company, 80% of jogger company. Now wait, the most important thing. See the year end. This is the year end. 31st of March X5 is the year end. 31st March X5 is the year end. So definitely the beginning of the year, go 12 months back, 1st April X4. So thank God there is no mid-year acquisition in this question. There is no mid-year. You acquired the company. You acquired the company on the first day of accounting period. You acquired the company on the first day of accounting period, okay? And there is 1 year gap. One more thing. From 1st April X4 to 31st March X5. From 1st April X4 to 31st March X5, there is only 1 year. There is only 1 year gap between the acquisition date, and disposal date, Okay. Why this gap is very important? See, 1st April X4 to 31st of March X5, 1st April X4 to 31st March. Why this gap is very important? Listen, for unwinding of discount of deferred consideration, you need to see this. Only 1 year unwinding is required. Number two, for for fair value adjustment, excess depreciation, depreciating assets, fair value adjustments, excess depreciation. This is also relevant. This is also relevant. Now, now 80% jogger company's equity shares when the retained earnings of jogger company was 19.5 million. Easy peasy, easy peasy. What's the acquisition date retained earning? Now these you have to prepare packets. We are doing with the net asset approach. You have to prepare acquisition date equity packet, and in the acquisition date equity packet you will be fitting 19.5 million retained earning. Don't forget. Now the consideration consisted of 42.5 million cash, 42.5 million cash consideration, and a further cash payment of 21 million, further cash payment of deferred until 1st April X5. So there are two types of consideration in this question. The first one is cash consideration and the second one is deferred consideration. Now look at me. According to 99% question, cash consideration, 100% question, cash considerations are already recorded by accountant. Cash considerations are normally already recorded by accountant. So, but deferred consideration we have to do with our own hands. No accounting entries have been made in respect of deferred cash payment. What does it mean? That means you have to record deferred consideration from zero. But yes, that also means, look at me, that also means that cash consideration is recorded. Now please use your this brain. In the asset side, investment is 55,000. In this investment, look at here, in this investment 42,500 is part of COI. This is part of COI cash consideration. Just think, in the balance sheet asset side of parent company, in the balance sheet asset side of parent company, this 42,500 is the COI. This 42,500 is the COI, right? So do 55,000 minus 42.5, it becomes 12,500. This is other investment. This is other investment. This is other investment outside the group. 12,500 are the other investment outside the group, and no need to cancel this other investment. Yes, we cancel out this 42,500. We cancel out this 42,500 at the time of making balance sheet, but no need to cancel this 12,500. Okay, these are the investments outside the group. Okay, now runner has a cost of capital of 8%. The appropriate discount rate is 0.926. Very easy, quick. What we'll do, as we have to pay deferred consideration after 1 year, just 1 year gap. After 1 year, we have to pay 21 million. So simply, I taught you yesterday, you need to calculate present value. And how you will calculate present value? That cash flow, how you will calculate the present value of future cash flow? That cash flow multiplied by discount factor, and discount factor is 0.926. So if you do 21,000 multiplied by 0.926, 21,000, can anybody do for me? 21,000 into 0.926? 19,446. So initially you have to make entry, and the entries are not required at all. I'm just making for you. Investment debit 19,446, and DC 19,446. Okay, this is the entry. Investment debit 1944.6, sorry, 0.6, it's 0.6, 1944.6, and deferred consideration credit, it's 19446, sorry, and deferred consideration credit. Okay, now you tell me, as there is only 1 year gap, open your eyes and brain, as there is only 1 year gap, so definitely the difference is unwinding of discount. The difference between 19446 and 21,000, the difference of 19446 and 21,000 is unwinding of discount, and the entry for unwinding of discount is interest expense debit, or I told you CR, retain earning, consolidated retain earning debit. What is the amount of interest? 1554, and DC credit 1554. Okay, so this is a routine thing. This is a routine thing you all must know. This is a routine thing you all must know. Okay, so this investment 199 is part of COI. This is part of COI, and it will be part of goodwill calculation. It will be part of goodwill calculation. This interest expense of 1554 will hit CR. This will reduce your consolidated reserve. Why? Because this deferred consideration loan, why this deferred consideration loan, this deferred consideration loan belongs to P company, and when the loan belongs to P company, this interest expense also belongs to P company. So when P company will book this interest expense, P company's profits will go down, and when P company's profit goes down, P company's retain earning and consolidated reserve will go down. Okay, so don't forget this. Just giving you 30 seconds, just take your time. Take your time. Now let's move to the fair value adjustment thing. Now, runner company, I will solve the question in one go. Okay, don't worry, I'll solve it. Runner company's policy is to value the non-controlling interest at fair value. Yes, it's full goodwill method. It's full goodwill method. It's full goodwill method. Okay, at the date of acquisition, the fair value of the non-controlling interest in jogger company was estimated ready-made. See, ready-made 13 million. Fair value fair value of NCI is ready made. Now I have a question. Come on, come on. No need to sleep. No need to sleep. Listen, this fair value of NCI goes at two places. Can you write? This fair value of NCI goes at two places. Can you write? Can you write? Fair value of NCI at acquisition. Yes, yes, yes. Number one in goodwill calculation. Number one in goodwill calculation. Number two in NCI calculation. Very good, very good, excellent. In goodwill calculation also it goes, and in NCI calculation also. Great, great, great. Good response. Now, what they are saying, the fair value of joggers companies, now S company, jogger company, as other assets and liabilities and contingent liabilities at 1st April X4 were equal to their carrying amounts, with the exception, come on, with the exception of a specialized piece of plant which had a fair value of 10 million in excess of its carrying amount. Means upward fair value adjustment, means upward fair value adjustment. This plant had a 10-year remaining very easy useful life at 1st April X4. Very easy. Now, this is a pure upward fair value adjustment. I hope you remember this C is equal to A minus L. As this asset is going up, so the net asset would also go up. So in the acquisition date packet, listen, in the acquisition date net asset packet, in the acquisition date net asset packet, you will write 10 million, you will write 10 million positive. But as this is a depreciating asset, as this is a depreciating asset, so you need to depreciate this revalued amount by 1 year. So 10,000, wait, 10,000 is the amount, 10,000 divided by 10 years. 10,000 is the revaluation amount divided by 10 years. So automatically this is 1,000 per year, 1,000 per annum, 1,000 per annum. And as the gap, open your eyes, as the gap between date of acquisition, as the gap between date of acquisition and date reporting date is only 1 year, as the gap between date of acquisition and reporting date is only 1 year, only 1 year, so we need to depreciate it only 1 year. So from 10,000 we'll subtract 1,000, from 10 you subtract 1,000, so you will get 9,000 at reporting date. You get 9,000 at reporting date. So how much amount you need to add in the packets? 10,000 in the acquisition date packet, 10,000 in the acquisition date packet, and 9,000 in the reporting date packet, 9,000 in the reporting date packet. Okay. And one very important thing, one last thing, one last thing, one last thing is that whatever you add, listen the words, whatever you add or less, whatever you add or less in the reporting date packet, you need to adjust in the asset side as well. You need to adjust in the asset side as well. That is 9,000. So what you will do, listen, you will add 9,000 here. You will add 9,000 in S company's property, in S company's property, plant and equipment, S company's property, plant and equipment. Okay. So it's a very routine adjustment. This is very routine adjustment, not no difficulty at all. Latest past paper, latest past paper. See, this is what they give in latest past paper. So you can easily do it. Now, next, in December X4, Jogger company sold goods to runner, S2P sale, S2P sale, S2P sale. Jogger company sold goods to runner for 6.4 million. Actual amount of sales, I think, is not that much relevant. Why? Why it's not relevant? Because this is not income statement question. If this is an income statement question, then actual amount of sales we knock off from income statement, okay? Earning a GP margin of 15% on sales. Yes, good news. When margin is given, you can directly multiply it with the selling price. As margin is profit percentage on sales, as margin is profit percentage on sales and directly ready-made selling price is given, so you will multiply the margin percentage with this sales to get the total profit. It's easy. Now, runner company held, now runner company still held, see the year end position, see the year end position, see the year end position. Runner company still held 4.8 million, still held 4.8 million of these goods in inventories at 31st March X5. Okay, so now these goods, these unsold goods contains URP. These unsold goods contain URP. So wait, let me make a little sketch. This is S company, this is P company. The actual sales is 6,400 and the unsold goods at the year end is 4,800, right? So there are different techniques of calculating URP. It's your wish. It's your wish how you do it. Some students do directly. See, as the year-end unsold inventory is 4,800. So URP is present inside this inventory. URP is present inside this inventory. So you can directly multiply it with 15%. Sir, why you are directly multiplying with 15%? Because this 4800 is the cost of P but selling price of S. This 4800 is cost of P company but selling price of S company, and S companies charges 15% on sales. S company charges 15% profit on sales, so you can directly multiply it with 15%. So this will give you 720. This is your URP. This is your URP. This is your URP. Now, S to P sale of inventory, S to P sale of inventory, and URP is there, and balance sheet question. You remember the steps? When now let's think together. When this is S to P sale, that means URP is booked by S company. So it is included in S company's profits, S company's retained earning. So you need to remove this URP from S company's reporting date net assets. You need to remove this URP from S company's reporting date net assets packet. You need to remove this URP from S company's reporting date net assets packet. Yes, yes or no? And from one more place, from the inventory, you should go to the group inventory. You should go to group inventory, and you need to remove it. You need to remove from group inventory as well. You need to remove it from group inventory as well. Okay, so 720 is the URP. 720, boys and girls, 720 is the URP which you need to remove from closing reporting date net assets packet, and group inventory. Now the last issue which is very good for learning, and that is cash in transit. Now yesterday some students told me to teach. I promised them that it will come. Now listen, cash in transit. Hold. Jogger company still had the full invoice value of 6.4 million in its trade receivables. See, Jogger company means S company, and this is your P company. Now listen, S company is the seller. Look at here, S company is the seller and P company is the buyer. Now just think, S company sold goods for 6.4 million. S company sold goods for 6.4 million. So S company must have booked a receivable of 6.4 million. See, so in the books of S company, there is a receivable of 6,400. Now, before 1 day before the year end, look at here, 1 day before the year end, the payable in P company was also 6,400. Please look at me. 1 day before the year end, one day before the year end, the payable was also 6,400. So it was aligned. But what happened on the last day? On the last day, look at me. On the last day, parent company made a check. On the last day, parent company made a check, and they gave this check. They sent this check to S company. So parent company must have made this. Parent company made this entry: payable debit. How much? I think it's wait 3,000. Payable debit 3,000 and bank or cash credit 3,000. Okay, so when parent company paid this check on the last day, so parent company must have reduced their payables. So after this payment, the payable is 3,400, but this cash is in transit. CIT, cash in transit. This cash has not reached S company. This cash has not reached S company by the year end. So that's why the receivable and payables are not aligned. The receivables and payables are not aligned. So this is the picture given in the question, you can read. This is the picture given in the question, you can read. Now the good news, listen the good news. For cash in transit, you have to make one entry and everything will be fixed. Just one entry and everything will be settled, everything will be over. Now wait, look at here, I'm going to make that entry for you guys. Listen. First of all, how much payable, this payable and receivable is intercompany. This payable and receivable is intercompany, and this need to be cancelled out, this need to be eliminated. Intercompany receivables and payables need to be eliminated at any cost, we know this fact. Now, how much payable of P company is left? How much payable of P company is left? See, 3,400. So we'll remove this payable P company, 3,400. And when we remove the payable, when we reduce the payable goes, liability goes down, payable debit. Now this cash is in transit, just take it to the destination. Whatever thing is in transit, take it to the destination. So when this cash will come to S company cash will go up by 3,000. And finally, how much receivable S company has? How much intercompany receivable S company has? 6,400. So we need to remove, it is mandatory to remove intercompany receivable. So you will credit S company receivable by 6,400. This is the one entry you have to make. This is the one entry you have to make, and everything will be settled. That's it. This is the one entry you have to make, and everything will be settled. Just make this entry and post it. Just make this entry and post it. You will win the match. You will win the match. Giving you 1 minute to analyze, giving you 1 minute to think over it, because some students face difficulty in this. Yes, this entry is very common entry. Just listen again. Whatever balances of payables and receivables are left, just remove it. Whatever balances of intercompany payables and receivables are left in the books, just remove it. And the cash in transit, take it to the destination. So obviously the cash of one company will increase. Now how are we going to post it? See, this is the posting. See. The payable of parent company 3,400, reduce it. The receivable of S company 6,400, and the cash balance of S company will be increased by 3,000. This is how we'll post it. See, this is how we'll post it. Please look at the screen. Look at the screen. Now, let's see anything is left or not. That's it. Prepare a consolidated statement of financial position of runner company at 31st March X5, 16 marks. See, these are latest past papers, and latest past papers are very ordinary. If you are focused, and you have prepared your exam document, your exam folder, then you can easily do it. So let's move on to the Excel sheet, and let me do it. And I hope you have the question with you. I hope you have the question with you. Okay, so just for the purpose of clarity, I am going to shut down my camera for few minutes so that you will have a big picture of Excel sheet, right? Okay. So now students, can you see the Excel screen? The Excel screen is with you. Can you see the screen? Yes. Okay. Okay. Thank you. Thank you. Now, let's start. Let's start. The name of the question is runner company. Wait, yes, this is the runner company. And let me wait. Let me. Okay. So first of all, listen. We in the first paragraph you have the question. In the first paragraph you need to do deferred consideration thing, okay? Or you can also do the net asset packet working. Can you see the share capital? Can you pick the share capital? Can you pick the share capital of, listen, wait, where is my question? Wait. Where is my question? Yes, this is my question. Now, can you can see the packets. What is the share capital? What's the share capital of S company at the year end? In the question, go and check. It's 25,000. The share capital of S company is 25,000. So the same share capital we'll copy at the acquisition date. No change in the share capital. I hope you remember. Now, what's the retained earning? You go in the first paragraph. What's the retained earning of S company at the date of acquisition? Retained earning is 19,500, 19500. And what's the retained earning at the year end? What's the retained earning at the year end? Go and check the balance sheet. 28,600, 28,600, right? So I'm going to make the packets. I'm going to make the packets. Now wait. Hope you remember the fair value adjustment. Come on. Tell me what's the amount of fair value adjustment. Fair value adjustment at the acquisition date was 10,000. 10,000. But hope you remember this 10,000 you need to subtract 1,000. You need to subtract 1,000 depreciation. So you will have 9,000 here, or you can write like this: 10,000, see, times 9 divided by 10. See, 10,000 into 9 upon 12, automatically 1 year depreciation will be deducted. See, this is this way you can also do it. 10,000 times 9 upon 10, automatically 1 year depreciation will be removed. Okay, done. So these are the packets. Now, I don't think so that anything we have to do with acquisition date thing. Acquisition date packet is ready. Yes, reporting date. Yes, reporting date packet has some issues. Okay, so acquisition date packet is 54. 54 500. Yes, reporting date we need to adjust URP, and that adjustment is left. Okay, giving you 30 seconds, giving you 30 seconds to analyze, giving you 30 seconds to analyze. Come on, easily you can do it. You can think over it. Now, come on, little focus now. Cash consideration for goodwill calculation, we have to calculate, we have to write COI. And in COI, first of all, we'll write cash consideration. Our cash consideration was 42,500. Our cash consideration was 42,500. Okay. Now, we need to do deferred consideration. We need to do deferred consideration. How we are going to do deferred consideration? 21,000 times point 0.9 0.926 0.926. You remember this? You have to do for deferred consideration, you have to do 21,000.926. See, I've written this also, and I'm solving. I'm going to apply the formula. You need to discount the deferred consideration. So we'll write equal to 21,000 times 0.926. Now wait, all of you wait. I'm going to tell you one exam technique. The reason of losing the marks. Openly, examiner has written this. See, you have to do, you can do it in the cell. You have to write the formula of multiplication, or it is optional to write on, see this side. I have written a extra here. I have written the same thing extra on the line, the working on the line. This working is see, 21,000 times 0.926, which is obvious. This working is optional, but listen, in the cell I have applied the formula. And what is the formula? Equal to 21,000 times 0.926. This formula is mandatory. If you do it directly from your calculator, if you do it 21,000 multiplied by 0.926 from calculator, and if you write direct figure here, so this may result in losing your marks. Examiner marker will be confused. Marker will say, from where did you get this figure? So one way you have to show the working, either on this side, or apply formula here. Okay. Now, fair value of NCI at acquisition is how much? Fair value of NCI at acquisition is 13,000 ready-made. 13,000 ready-made. Okay. So let's calculate this total. 7474946. And then see, we need to deduct the fair value of net assets. At acquisition. Fair value of net assets at acquisition. See, what's the acquisition date net asset packet? Is 54,500. It's 54,500. Okay. So our goodwill is ready. This less this. See this. Okay. Your goodwill is 20446. One thing, don't forget that we have right now we have included deferred consideration of 19,446 in COI, but but we need to adjust the unwinding of discount as well. We need to adjust the unwinding of discount in the consolidated reserve section as well. Now let's do the URP. Let's do the URP working. Let's do the URP working. URP working. Listen. What's the unsold inventory? It's 4800 times 4800 times 15%, 0.15. Okay. So you can do it here, equal to 4800 times 0.15. See, this is your URP. 720 is your URP. 720 is your URP. Okay. Now this URP will be deducted. This URP will be deducted from two places. This URP will be deducted as this is S to P sale. My dear student, as this is S to P sale, so S company has booked the URP. So this URP will be deducted from C. S company's closing net asset bracket. S company's closing net assets packet. S company's closing net assets packet C. I have deducted, and one more place from we have to deduct, and that is group inventory. We need to remove this URP from group inventory as well, Okay. Now wait, your closing net asset packet is also done. Your closing net asset packet is also done. Wait. Okay. So you have your acquisition date net asset packet as well as reporting date net asset packet. Acquisition date net asset packet as well as reporting date net asset packet. Now one question, wait. One question is, sir, cash in transit, how we'll directly adjust cash in transit. We will directly adjust cash in transit in the balance sheet. Don't worry at all. Now, we all know we have made the packets of acquisition date and reporting date. Unwinding of discount will be directly deducted from consolidated retained earning. One guy is asking, unwinding of discount belongs to P company. Unwinding of discount is the expense of P company, so it will be directly deducted from consolidated reserve. It will not be deducted from S company's net assets. Okay, be careful. Now listen, one thing. Can anybody tell me what is the S company's post net assets, post retained earning? Can anybody tell? I will calculate, don't worry, but can you guys tell me what is the S company's post retained earning? Yes, 7380. 7380. Very good. 61880 minus 54,500. 61880 minus the difference between these two packets. The difference between these two packets is S company's post retained earning, right? Now, let's calculate the fair value of NCI for balance sheet. NCI for balance sheet. I hope you remember this. Please look at me. Please look at the screen. In consolidated SOFP, in consolidated SOFP, NCI is recorded at fair value. In full goodwill methods, consolidated SOFP NCI is reported at fair value. But fair value already ready-made given in the question, but it's given of acquisition date. So you need to adjust S company's post net assets share in the NCI. So let's write, what's the fair value of NCI? What's the fair value of NCI, boys and girls? The fair value of NCI is 13,000. Look at here. The fair value of NCI is 13,000. Now let's adjust the post share. The post share is how much? Equals, bracket open, wait. Now first we'll pick this minus, wait, look at here. This minus the second number is this bracket close. Look, see, I have applied the formula. Multiply by, I think our holding percentage in this question is 80. Yes, our holding percentage in this question is 80. So NCI holding percentage must be 20. See, I have applied the formula. Y11 minus T10. Y11 minus T10 multiplied by 0.2. Can you see the formula? Can you see the formula? It's 1476. Let's add. That's your NCI. 14776. 14776 is your NCI. 14776 is your NCI. Okay, check it out. Check it out. Please have a look. Now, consolidated reserve. How do we calculate consolidated reserve? First of all, First of all, we have parent companies retain earning. First of all, we have parent companies in consolidated reserve means consolidated retain earning means group retain earning. Group retain earning means combination of both companies retain earning. So pick out parent companies retain earning. What's the parent companies retain earning? Is 286,600. Parent companies retain earning is 286,600. Okay, and then now, subsidiary companies post retain earning, subsidiary companies post retain earning, subsidiary companies post retain earning. How do we calculate post retain earning? Share bracket open. Now, this minus this 54,500. Okay, shift bracket close. Now, what's the NCI holding percentage? 20% is the NCI share. That means our share is 80%. Our share is definitely 80%. So multiply it with 0.8. 0.8. Okay. You can see the formula. You can see the formula on the screen on the top. On the top, there is a formula. On the top, boys and girls, there is a formula. There is a formula. You can see. You can see. So let me press enter and that's done. Oh, yes. Yes, 5904. 5904. 5904. Okay. See, you can again see the formula. Now, finally, you have to write unwinding of discount. You have to deduct unwinding of discount. I hope you remember unwinding of discount. Here in this question, there is only 1 year. There is 1 year gap between the payment date and the acquisition date. So just simply take the difference of 21,000. Simply take the difference of 19. How much? I think 19446. 19446 minus 21,000. You will get a negative expense. You will get a negative expense. And yes, we want a negative expense. Yes, we want expense in negative seed. Okay. So that's your consolidated reserve done. Okay. So in front of your screen, you have everything. In front of your screen, you have everything. You have everything. You have everything in front of you. You have goodwill, you have goodwill, you have fair value NCI, you have consolidated reserve, and you have acquisition date net assets packet as well. You have acquisition date net assets packet as well. See, and you know, it's working on Excel and software, it's not difficult. It's very user friendly. If you do it, you will, it may save your time as well. Yes, better you bold. One student asked, better you highlight something, you underline something. This is all comes in formatting, and this gives good impression to the examiner. Yes, yes. Now let's go to the balance sheet. Finally, adding together. Finally, you need to do adding together. Finally, you need to do adding together. I hope you remember my discussion I taught you in C. The first thing is property, plant, and equipment. The first thing is property, plant, and equipment. Come on, keep question in front of you so that you can easily. Parent company's property, plant, and equipment is 455,800. Parent company's is 455,800 plus subsidiary companies is 44700. And I hope you remember, I hope you remember the 9,000 fair value adjustment. You added 9,000 in the reporting date net asset packet. You added 9,000 in the reporting date net asset packet. See this, see these three things, see these three things. Okay, let me press enter. See, it's done. It's done. 509,500. 509,500. It's done. Okay, now the next thing is investment. If you remember the question, I just use pen in on the question paper in front of you. Already listen my words. Look at here. Or if you remember, I just turned on the camera. If you remember, 55,000 investment written in P company's asset side. In that 55,000, 42,500 was part of COI. From that 55,000, 42,500 was part of COI. So remaining 12,500 is outside the group. Remaining 12,500 investment is outside the group. And you know, outside group investments are never cancelled. Outside the group investments are never cancelled. So yes, we have to write this 12,500. We have to write this 12,500. Okay, now let's pick the goodwill. Goodwill, we need to pick ready-made. Goodwill, we need to pick ready-made. We have already calculated. We just write equal to, and we'll pick, wait. We'll pick goodwill. That's it. Okay. So that's your goodwill. Now you can also add the total non-current assets. Yes, you can. Okay. Now inventory. Just by looking at inventory, one thing is coming in my mind: URP, boys and girls. Let's add the inventory. Parent company's inventory is 22,000. Parent company's inventory is 22,000. Subsidiary company's inventory is 16,000. And I hope you remember the URP is 720. URP is 720C. Parent companies plus subsidiary company less 720. Okay. Now, trade receivables. Now, hope you remember the CIT, the cash in transit, intercompany cancellation. Hope you remember that intercompany cancellation. I made entry for you. And in that entry, we reduced in that entry, we reduced 6,400 trade receivable of S company. Okay. So let's do it. Parent company's receivables 35,300. Parent company's receivable is 35,300 plus subsidiary company receivable is 9,000, and then remove 6,400 intercompany. Then remove 6,400 intercompany. So now bank balance. Parent company is 2,800. Parent company is 2,800 plus subsidiary companies. Plus subsidiary companies is 1,500. And I hope you remember there was a 3,000 cash in transit. There was a 3,000 cash in transit which we have to add. Okay. Now let's calculate the total assets number. let's calculate the total asset numbers. Six two four nine two six. 624,926 is the total assets. 624,926 is the total assets. Okay, giving you 30 seconds. Now come to the equity side. I hope you remember the basics. In the equity side, share capital, only parent company's share capital we write 202,500. Please concentrate, only last few minutes. 202,500. Parent company's share capital is 202,500. Now, instead of retain earning, we just copy consolidated reserve or group retain earning. Just copy and connect the consolidated reserve, or group retain earning. Consolidated reserve or group retain earning. Wait. Where is consolidated reserve? This is okay. Now, and then in the equity section, one more thing comes, and that is NCI. See the original question. NCI also comes. NCI. We did working for NCI. Let's connect it. NCI 14476, I think. Yes. So now you can add the total equity. Okay, you can add the total equity. Now in current liabilities, there are trade payables. Yes, and don't forget the cancellation. Parent company's trade payables is 81,800. The subsidiary company's trade payable is 17,600. Now wait. I hope you remember there was an intercompany cancellation of 3,400. There was an intercompany cancellation of 3,400 of parent company's payables. You remember 3,400. Okay, so that's your total 96,000. One more thing. I hope you remember you have to pay. Listen, your year end is 31st March X5. Your year end, boys and girls, please, last few minutes. Your year end is 31st March X5. 31st of March X5. And you have to pay deferred consideration on the very next day. Listen, the payment date of deferred consideration is 1st of April X5. The payment date of deferred consideration is 1st of April X5, and your year end is 31st March X5. Just one day, just after one day you have to pay. So that's why your deferred consideration is your current liability. In this question, deferred consideration is a current liability. Okay, and we have first we did discounting, and then we did unwinding. Please think over it. First we did discounting, and then we did unwinding. So finally we came to 21,000. Finally the total came to 21,000. So my dear student, our current liability is 21,000. Our current liability is 21,000. Okay, now let's see the balance. Its balance. Okay, 21,000. Why? Wait. There is a question by a student. Why are we recording 21,000? Is this not intercompany? Is this not going to be cancelled with intercompany balances? No. This, listen, parent company buys S company from S company's shareholders. Parent company buys S company from S company's controlling shareholders, and they are individuals outside. They are individuals outside the group. So this liability is a real liability of the group. This will not be cancelled. This 21,000 is not to be cancelled, because parent company has to pay to individuals outside the group, the shareholders. You know what thing we cancel? Listen, what things we cancel which are intercompany, between parent company and subsidiary company, between parent company and subsidiary companies, intercompany transactions are cancelled. But when parent company has to pay to shareholders, when parent company has to pay the shareholders of S companies, then this is the real liability. This is not intercompany. Okay, be very careful. I have seen in past in examiner reports, students do this mistake. So you don't know, you should not repeat this. Okay. You can have a look. You can have a look. You can have a look. Okay. Now there is one requirement is left, which is very easy requirement related to associate. And just I'm giving you a quick recap of associate. When you have significant influence in any company, then that company is your associate. Normally associate, you get significant influence when you have more than 20%, and less than 50% shares, then you get significant influence normally. But there are exceptions as well. There are exceptions as well. Sometimes you have less than 20% shares, but still you get significant influence through contractual arrangement. So real thing is significant influence. Now what happens when you have significant influence in some company? Then you do equity accounting. There is one line adjustment. Then you do equity accounting, that is one line adjustment. No need to do adding together, no need to do line by line complete adding together, just one line adjustment. And I taught you this yesterday. Okay, so you can do the last requirement. I hope you understood all the things, and it will help you in your exams. So we'll plan one more class next week. I'll update you on the WhatsApp group. Okay, right? So work hard and don't waste your time. You are with the last days. I think you have now maximum 18 or 17 days with you. So each and every day is very important, right? So now it's time to say goodbye. Take care. Allah Hafiz.